Look, we've all been there. It's Friday night, your friends are over, the mood is right. Someone whispers the magic word, pizza. Suddenly it's not a suggestion, it's a biological necessity. But then comes the horrifying realization. Your wallet contains nothing but a 2-year-old receipt for a questionable haircut and a family of dust bunnies. You turn to your friend, the one with an actual job, and say, "Spot me a 20, I'll pay you back on Tuesday, I swear on my non-existent honor." Congratulations, you've just entered the thrilling high-stakes world of informal debt. It's a world built on promises, trust, and the very real possibility that you'll forget about it until your friend brings it up at your wedding. But imagine if Apple tried to borrow $1 billion from a bank with a casual, "Hey guys, spot us a cool bill, we're good for it, promise." The entire financial system would implode. The world's economy would grind to a halt, all because Tim Cook tried to finance the next iPhone with the same casual energy you used to borrow money for a large pepperoni with extra cheese. And that, ladies and gentlemen, is where the glorious, the magnificent, the slightly boring but incredibly important world of accounting swoops in to save the day. Yes, accounting, the profession that makes spreadsheets look like a wild night out. It takes our flimsy, pizza-based promises and turns them into something concrete, something you can't just conveniently forget about. So, what in the name of all that is holy is a note payable? Let's break it down. Think of it as the grown-up, legally binding version of the IOU you scribbled on a napkin. It's a formal written promise, a promissory note, that a company makes when it borrows money. The key word here is written. This isn't a handshake deal made in a dimly lit alley. This is a document with signatures, dates, interest rates, and a maturity date, which is just a fancy way of saying the day the financial Grim Reaper comes to collect. It's a liability, meaning it's money the company owes to someone else, like a bank, another business, or even a very wealthy individual with a monocle. The payable part of the name is quite literal. It means it has to be, well, paid. Shocking, I know. This distinguishes it from its less formal cousin, accounts payable. Accounts payable is for your day-to-day short-term stuff like buying office supplies on credit and promising to pay the bill in 30 days. It's the "I'll get you next week" of the business world. A note payable, on the other hand, is more serious. It usually involves a larger amount of money, a longer repayment period, often more than a year, and critically, it almost always involves interest. Let's bring this down to earth with an example that doesn't involve billions of dollars. Imagine you want to start a gourmet pizza delivery service. But not just any delivery service. You're going to deliver on a custom-built, ridiculously cool, solar-powered bicycle with a built-in oven. This magnificent machine costs $5,000. You, however, do not have $5,000. You have that same dusty wallet from before. So you march into the first bank of mom and dad and make your pitch. They agree to lend you the money, but because they've seen your track record with pizza money, they want it in writing. They are, in effect, the lender. They draw up a document. It says you, the proud owner of a future pizza empire, promise to pay back the $5,000 in 1 year. They also add a little something extra for their trouble. 5% annual interest. You both sign it. Boom! That piece of paper is a promissory note. For your parents, it's a note receivable because they will receive the money. For your fledgling pizza business, it's a note payable because you have to pay the money. It's a liability on your company's books. A constant reminder that your solar-powered dream machine was funded by someone else's generosity and financial prudence. Now let's scale it up. Let's say your pizza business is a smashing success. You're the talk of the town. You want to expand and buy a whole fleet of 10 oven bikes. That's a $50,000 investment. This time you can't go to your parents. Their bank is closed for the evening. You go to a real bank. The bank reviews your business plan, sees your incredible success, and agrees to lend you the $50,000. They have you sign a much more intimidating multi-page document filled with legal jargon, but the core idea is exactly the same. All right, now for the part that scares people, the journal entries. But don't panic! This is not black magic, it's just organized note-taking. Think of it as telling your company's financial story. We use a system called double-entry bookkeeping, which sounds complex but just means every transaction has two sides, like a coin or a very boring argument, a debit and a credit. They must always be equal. It's the law of accounting. Let's go back to our first example, borrowing $5,000 for that amazing pizza bike. On August 18th, 2025, the money hits your business bank account. Your business now has more cash, which is an asset. To show an increase in an asset, you debit it. At the same time, your business has a new obligation, a new liability. You owe $5,000. To show an increase in a liability, you credit it. So, the journal entry, the first sentence in our financial story, looks like this. It's simple, clean, and perfectly balanced. Now, fast forward. A year has passed. Your pizza business is thriving. It's time to pay back the loan, plus the interest you promised. The interest is 5% of $5,000, which is $250. This interest is an expense for your business. It's the cost of borrowing the money. You're debiting two things, the note itself and the interest expense. You're paying with cash, so your cash account will decrease by $5,250. The story ends with this final entry where you heroically slay the dragon of debt. It's a beautiful moment. And there you have it. You've stared into the abyss of accounting and the abyss blinked first. You now understand the mystical note payable. It's not a creature from a fantasy novel, it's just a formal IOU that helps the wheels of commerce turn. It's the difference between begging a friend for pizza money and building an actual business. It's a written promise, a liability, and a crucial tool for growth. You've seen how it works, from borrowing for a single bike to financing a whole fleet. You shouldn't be intimidated by it. You should feel empowered. The journal entries, the debits, the credits, that's just the language of business. It's how accountants tell the story of where money comes from and where it goes. Once you learn the basic vocabulary, you can read the story of any company. You can see how they're funding their dreams, paying their debts, and whether their grand plans are built on a solid foundation or just a series of increasingly desperate pizza money IOUs. The truth is, accounting gets a bad rap. People think it's just for stuffy people in visors who love math more than they love other humans. But that's not true. Accounting is the story of human ambition. It's the story of someone with an idea for a solar-powered pizza bike who needs a little help to make it a reality. It's a rule book designed to make the game of business fair and transparent. It ensures that when someone promises to pay you back, there's a record of it. It's a system built on logic. And once you see the logic, the fear melts away. So go forth with this newfound knowledge. Don't be afraid of the financial statements. Don't run from the debits and credits. You've tackled notes payable, one of the fundamental building blocks of the balance sheet. You are, for all intents and purposes, an accountant in training. And that's fantastic. Because understanding how money works is a superpower. Now, if you'll excuse me, all this talk of finance has made me hungry. Who wants to spot me at 20 for a pizza? I'll sign a promissory note and everything.